Well, we felt all along September was the most likely liftoff date, and it's more or less the consensus now. A lot of it is the economy. There's a lot of mixed signals, but housing and the employment data is strong enough that we think on balance the Fed is going to want to start this process of getting rates back to normal. It's going to take multiple years, but we still think September is the most likely course of action.
You know, Dave, a lot of people in the market took solace in the fact that you had some really poisonous stuff going on in Europe. The kind of language they're using, you know, that whole Greek exit is because it's going to arrive the way things are going. The clock is ticking by, and yet the markets got excited about Cody and NCR. Imagine that.
Yeah, well, it was clearly a quiet news day. There was not a lot of new news on Greece, and we don't get any comments from the Fed until tomorrow. So investors had to latch on as little minutiae as they could. There was not a lot of news to move the markets today, so they grasped what they could.
What are you kidding me? Donald Trump just announced his candidacy to run for the Republican nomination. That's not news?
Save America.
Big news, big news. But unless he moves all the money he's going to spend on his candidacy into the equity markets, we don't think it's going to have a lot of impact.
He probably uses that a lot on his hair already.
Yeah, and his plane, too. He's got his own 757 all kitted out because he's got a lot more toys than the others have. So, Dave, given all that you, Sue, and I have talked about so far, what do you do right now? Because you've been taming yourself and calming yourself on U.S. equities, right? I mean, you know in your heart of hearts that a lot of them are really at the top ceiling of valuation. So even in a minefield like Europe, you're actually increasing your exposure and your attention and your time spent looking over there.
Absolutely, because it's all about what we find in terms of valuation versus expectations, that collectively expectations on Europe are still moribund. Now, the economy is not doing well, but it's certainly doing better than most investors expected. You are seeing some follow through in terms of capital investment. The actions of the ECB seem to be having some impact. There are obviously problems in places like Greece, but we're an individual security selection type firm. We hire managers that can pick the good companies that can adjust to the minefields that you're talking about. But overall, valuations are attractive. Now you're seeing these companies having a competitive advantage of roughly 15% versus the dollar as they're competing against U.S. businesses. And that currency tailwind is flowing through their income statement. So we think you're going to see expanding book values and earnings per share over the next 6 to 12 months from European companies. And they're trading at roughly 1.8 times book in Europe versus 2.8 times book in the United States. So you're getting a nice discount versus some of the big companies in the U.S. So we still think it's a good place to put your money. And as we talked about last time, it was a few months ago, we still like emerging Asia. China looks to be a bit of a bubble, particularly the air shares. I know they came back quite a bit today. But places like South Korea, India, Malaysia, Thailand, we still like good growth. Are very attractive valuations, emerging middle class, so we still think it's a good opportunity to put capital to work in emerging Asia.